Good afternoon. This is Shubhankar Sen speaking. Along with me, Mr. Bankar, CFO, is there. Before we begin, we would like to wish all of you a very happy Valentine's Day. Today is 14th of February, and along with that, today is also the auspicious day of Saraswati Puja. And may all of us driven by more knowledge and more love, and have a very happy and successful life. Now that we come to the numbers, the performance as a team, Senco Gold and Diamonds, we are extremely happy and excited to inform all of you that if we look at our overall performance, quarter 3 and YTD 9 months have been a great performance. This year has been a milestone year for Senco for the fact that we've got our company listed, and it is a big responsibility to ensure that the trust and the performance of our team continues to be at its best. So just coming to the numbers, if we look at our quarter 3 results, we've done a turnover of 1,650 odd crores for FY24 compared to 1,339 crores in quarter 3 of FY23, which means that there has been a 23.3% growth in terms of revenue if we compare on a quarter-on-quarter basis. And if we look at the YTD numbers, 9 months FY24, we've done about 4,104 odd crores compared to 3,263 odd crores for 9 months in FY23, which means that our growth has been in the range of 25.8 to 26% for a 9-month basis. Now, what is it that has driven the performance and the top line growth is the fact that quarter 3 is a quarter of Dhanteras, Durga Puja, festive season, Navratri. We are all aware that we've seen a large number of weddings that has happened in this particular quarter. We have been speaking of around 35 lakh weddings happening all across the country. So putting everything together, we've seen that there has been a huge response from the consumers in terms of buying and purchases for the festive season. Yes, we've seen that, towards the end of quarter 3 in December, there has been a slight slowdown with the, end of the festive season, which happened around 15 December. But as we moved on to January, we could still see a slight increase in terms of interest amongst consumers in terms of purchases. If we look at our EBITDA, Mr. Baka will get more into details. But all in all, we've seen that on a 9-month basis, we've grown EBITDA levels at 15.2%. In terms of PAT as well, if we compare to the 9 months FY23 to 9 months FY24, we've moved up from around 132 odd crores to 148 odd crores. So around 12.4% has been the growth in terms of PAT. The number of stores that we've added for this particular quarter today, we can see that for 9 months we've added around 19 stores under the kitty of Senco Gold and Diamonds. So therefore, our number of stores, as I speak to you today, stands around 158 stores as on 2nd of February 24, or as we speak to you today. In terms of overall, what has been the lever that has helped us to perform for the whole year? We can say that there has been a steady shift from the unorganized to organized. We could see that the old gold exchange that we have been getting from our consumers has been approximately 33 odd %. And the best part is that, a large quantity of old gold that is coming from the consumers, which is approximately 75 to 80% of the old gold that we have received, is the old gold which does not belong to Senco. That means that, consumers have their idle old gold lying with them. So along with the purchases that they are doing, they are ensuring that with the hallmarking becoming mandatory, they are converting their old family jewelry that is there and buying new jewelry. In terms of certain exciting new initiatives we've taken, we have opened 2 stores as a pilot under the brand name of Sines, which is the brand that we have launched for lab-grown diamond jewelry and leather accessories. So in the city of Calcutta, we've opened 2 stores in a mall, in 2 malls, 1 store each, and that would be focusing on driving the lab-grown diamond journey. We want to understand how the consumers will behave. We believe that there is a big potential in the future. So along with the fact that, the overall performance, we've grown by 9% in gold jewelry segment. We've grown 40% value terms in diamond jewelry segment. If you look at the volume, we've grown by 27% in volume in diamonds. So those numbers are doing well. What we are seeing is that especially for the smaller ticket size items, consumers are preferring studded jewelry, and that is where our studded ratio has moved up from 11.4% to 11.8%. And that is the reason what we see is that with 14 karat and 18 karat hallmark purity of gold that is being used for the studded jewelry, it is becoming more and more affordable for the consumer to shift from buying 22 karat plain gold jewelry for the small ticket size to the diamond jewelry, and that is driving the overall sales for the business. Solitaires, pointers, we have seen that there has been price corrections that have taken in the segment of diamonds, which is 30 cents and above. And we as a company have been focusing on ensuring that more and more consumers can afford to buy solitaires in the natural diamonds category, and accordingly we are focusing on the same. So with that, I would now request Mr. Banka to take you through the details of the numbers. And in terms of collections and designs that we have launched, we have seen that with the wedding season we had the Vivah collection that was launched. During Dhanteras we had Shagun collection, which was the average ticket size of 50,000 to 1 lakh rupees. A lot of designs were launched under the diamond category as well. And very recently, we've launched the Ram Mandir collection with the onset of, the Ayodhya temple. So we were one of the first few jewelers to launch the collection regarding the, in the honor and memory of Lord Ram. At the same time, in terms of new initiatives, ONDC is a platform that is being created by our government to ensure that we can penetrate deeper into the tier 2, 3, 4 cities. And we've been one of the first few jewelers to get ourselves enrolled in the platform to reach out to the customers at large. Now, just a little bit of yes, 19 stores we've opened. The number of franchises out of those 19 stores has been 4. The company-owned, company-operated stores have been 15. And going forward, we would like to continue with the 18 to 20 stores to be grown year after year. So the endeavor will be that, yes, we want to open more franchisee stores. This year, with the gold prices moving up a little bit, the number of franchises have been comparatively lower. But that is something that we are conscious of, and we'll try to focus on ensuring the number of franchises keeps growing. And with that, I would now request Mr. Banka to take you through the detailing of the numbers.
Yes. So thank you very much, sir. While we have given a broad background of number, our EBITDA percentage has improved substantially in the current quarter, while it was lower in the Q1 and Q2. So we achieved the EBITDA percentage of 11% in the current quarter, and hence overall our 9 months EBITDA improved to 7% as against 7.7%. And similarly, our profit after tax for the current quarter, we achieved 109 crores. So till H1, it was around 40 crores, and with 109 crore of tax for the current quarter, for the whole year we have achieved 148.9 crores as against 132 last year. So we have achieved a 15.2% growth in EBITDA and 12.4% growth in PAT. Here it is important to state that EBITDA growth is a function of the investment. So as we are growing, we have to continue to make investments in scaling up our people, in investing their training. The marketing costs we have consistently developed, and particularly in the current year, we have gone to tier 3 and tier 4. Like, we have gone to Bhagalpur, Ara, Jaleshwar, Dumka, places, such areas where there are huge potential. And hence, in order to realize the full potential, we have to continue to invest, and that's why you are looking at a 7% EBITDA margin. Similarly, a major part of this growth has come from triple S growth, which we call SSSG, which is in the range of 17%. So out of the 26% growth, 17% growth is the triple SG growth. What is more important to understand that this triple SG growth is much higher in South, where it is 24%. So zone by zone, as you said, is secular growth. The zones or areas where the per store sales was lower, there we have achieved a higher growth. So overall, as you said earlier, we continue to look at minimum 18 to 20% growth in terms of our last CAGR trend of 20%. As we have grown 15 plus 4 stores in the current year, that has led us to invest in the working capital. So our inventory has also increased from March 23 versus December 23 by around 350 to 400 crores. We also have invested in capex for the store. So overall, we have looked at maintaining the growth momentum, investing in future, and investing in inventory. Incidentally, as you stated earlier, our blended borrowing cost, which is sum total of gold metal loan and our working CCWCDL, is below 6%. So that helps us to maintain the growth momentum. And as you said earlier, our debt equity ratio, debt primarily the working capital, will be in the range of 1.2 to 1. With that, we stop our remarks, and we invite you to ask any pertinent questions so that we can delve more in the performance so far.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Vidisha Seth from Ambit Capital. Please go ahead.
Yes, thank you. Sir, can you give some sense on the ongoing demand trends for the current quarter? Has the 20-25% growth momentum continued? And just as a follow-up to this, what is keeping the jewelry sector insulated from the overall consumer slowdown? We understand that the category is pseudo asset class type of nature, but just wanted to get your take on how long can this growth momentum continue for you and the overall sector. That was my first question.
Right. So see, quarter three, usually with the weddings that were in place, was always having a much better performance. But this particular quarter, we've been running Valentine's Day offer. There have been weddings that have been happening in this particular quarter as well. So if you really ask us, as we began our journey in the beginning of the year, we had given an estimate of a growth trajectory of around 20-odd%. Now that we are ending the 9 months and we are at about 26%, so obviously our 20% growth over the last year is very much in the radar. And I think that we will be overall as we end the year in a very conservative estimate, because we've always been very conservative in giving you the guidance, should be in the range of 23-24%. So it won't be as the same as quarter three. And we are all aware that in the month of April, May, the elections are going to come up in the economy. So there will be March is a month where the people are more busy in terms of paying their taxes and closing their books of accounts. So the consumer behavior is a little bit of a conservative during quarter four. Valentine's Day weddings is one trigger for sales. Women's Day in the first week of the March is another trigger where there are reasons for buying. And then as we end the March, there are usually offers for Gudi Padwa is there in certain regions. But then some amount of year-end offers and sales happen. But then the focus then for the organization and for the industry shifts to April, May, which is Akshaya Tritiya. And Akshaya Tritiya is on the 10th of May. So build up of inventory, planning, reaching out to customers. Customers wait for the new year to begin. So this is how the journey continues. So this is what would be my answer to your question.
All right, got it. And second question was on our operations in the northern region. Can you share what kind of improvement that the company has seen in the revenue throughput during this quarter or over the last 9 months? Basically, has the gap between the revenue throughput in the north, has it narrowed versus east? Just trying to understand how far away are we from attaining optimal store throughput in that region.
So if we look at the blended, so basically North is mostly the own store. There is only one franchisee store in Aligarh. If we exclude that franchisee store, what we have said that our overall average sale per store is 37 crore, which was around 33 crore last year. So North has seen an improvement. So now North and East average is same. So let's say East is 27 crore, North is 28 crore per store per annum. So we have clearly seen an improvement. Even South has also reached 27 crore. So what we have said earlier in various calls, so if a store achieves a minimum turnover of 15 crore, it can be 13 crore also, then it achieves a break-even at a store office level. And the moment it touches around 21 to 22 crores, it becomes a full 100% break-even and it covers the interest cost. So that is what is the situation in North, and North had a huge potential. So now we have 22 stores in North. So almost 10-11 stores in UP and around 10-11 stores in Delhi NCR. So we see a huge potential, and that is also signified by a high spread ratio which we have seen in North. So overall, we are very positive about the North, and that will continue to be cornerstone of our future growth strategy, East and North, as you say.
And one more thing, if we again delve a little bit deeper, while East is growing at around 16-17%, North is growing at around 20-22%. So the rate of growth for North, again, because the base is lower compared to East, and also, we are there as a newer brand in the North, and the potential of growth is that much more. While in East, in Bengal, there is still scope of growth. It is not that the scope of growth is anyway lower, but North, the growth is much higher. So the focus continues to remain, and the stud ratio in the northern part of the country, as mentioned before as well, is almost double of that of the eastern part of the country. So that is also a very strategic focus area for us to focus and ensure that the bottom line continues to remain strong due to the sales in northern part of the country.
Got it. Just one clarification. The 20-22% growth rate that you mentioned for North, that's for the current quarter or for 9 months?
Nine months. That is 9 months.
9 months.
9 months.
Okay. Got it. I'll get back in the queue for further questions. Thank you.
A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yes, sir. Hi. Congratulations on a good Q3 performance, as well as many firsts that you have introduced in this quarter in terms of lab-grown diamonds, ONDC, as well as the Ram Mandir collection. Question first is on lab-grown diamonds. So Suvankar, prices are continuously declining for such diamonds. I guess this is more due to commoditization with more and more sort of people entering this space in terms of manufacturing. So wanted to check your thought process for entering into this category. So any color on this?
No, Devanshu, see, the point is, it is, the price going down is a factor of the supply that is increasing. But the demand it has not been created to the extent that the supply has been there. One of the reasons for the price going down is that, in the last 3-4 years, I'm aware, being a part of the Export Promotion Council, is that there have been large exports of lab-grown diamonds, and US as a market was in high demand for that particular product. But over the last 6 months, there has been a slight slowdown in the US economy, leading to a lot of products that comes back from that country. They give it on sales on a return basis and various other options. So therefore, suddenly there is an excess supply of lab-grown diamonds, where players like us are planning to build up the demand. We have the customer base. We will reach out to the customer. And also this commoditization which is happening is an unfortunate phenomenon, because ultimately there is a demand for studded jewelry. The lifestyle of the consumer, the way it is changing, people are preferring to wear Western designs more compared to the traditional designs, unless there is a traditional occasion in the family, be it a wedding or a puja or any kind of such auspicious occasion. But other than that, on a day-to-day basis, it is going to be Western designs that will drive the sales. So I think it is up to various organizations and brands to focus on designs, and that is what we are trying to focus upon, the design aspect of it, the experience, retail experience aspect of it. And in that kind of an experience, if we can provide the product to the consumer, I'm sure that the future is bright. Yes, it will not be a substitute to diamond jewelry, because diamond jewelry is natural, real. It will have its own inherent value to be captured over a period of time. And lab-grown diamond jewelry will be focusing on the fashion aspect of it. So we need to play accordingly and cater to the needs of the consumer. But the journey is just beginning. We have launched with a pilot of 2 stores. I'm sure others will also follow very soon. And then gradually, as the demand gets created, the prices will stabilize.
Got it. And Suvankar, is there any difference in customer profiles for people who purchase lab-grown diamonds and natural diamonds?
See, in our last 3-4 months, we have seen that those buyers who are buying lab-grown are very much those buyers who have been buying diamonds also, right? So once you fulfill the need of buying a natural diamond in whichever size or form, then as a second level in terms of variety of diamond or some kind of requirement and a desire to have a bigger size at a lower cost. So those are the way things are moving, and that's where it is.
Got it. Second question is on the store opening. We have done very well on company operated stores with 12 openings in Q3. I guess this would have required incremental capital of about 250 odd crores. So have we seen some increase in debt, or we were able to meet this capital through internal accruals?
So Mr. Banka will take on the debt figures, but we also need to keep in mind that we had our IPO in the month of July. So therefore, that cash inflow into the organization was fully utilized in terms of the inventory stocking, whether it be our existing stores or the new stores we have opened. And as far as debt is concerned, Mr. Banka, you can speak.
So basically, our inventory level has increased versus March by almost, let's say, 268 and around 400 crores. So we have raised IPO funds around 270 crores. So the incremental inventory and incremental capex, net of borrowing, net of internal accrual has been funded by the borrowing only. So the borrowing which has reduced during July, August. After that, it has consistently increased.
Got it. Can you call out the debt figure at December end? What is the debt level?
So December end debt working capital figure should be around 1346 crore. So when we started the year, it was around 1177 crore. And as of December, it is around 1346 crore. So around 140 crore, 170 crore of incremental borrowing. So this incremental 170 crore plus around 270 crore of IPO funds and then internal accrual. So there has been capex involved also.
Got it, Mr. Banka.
And to add to that, Devanshu, the average cost of debt for us is in the range of 5.5% to 6%, because most of the debt that we have taken is in the form of gold metal loan. Yes. So that is how the whole thing is.
Got it, sir. Got it. And so, Uncle, you mentioned that the franchisee store has not improved because of elevated gold prices. But from peers' perspective, we see that they are opening quite a aggressive number of franchisees. So, any bunching up of franchisee stores that we can expect in the coming quarters for Senco?
So all I can say is that there are franchisees in the pipeline. Quarter 4, project work is on, and there might be 1 or 2 stores that gets added in quarter 4, and a few more stores that get added in the quarter 1. of the next financial year. So while our full appreciation and for the effort that has been put by the other fellow jewelers in ramping up the franchising business, but it just gives shows all of us the opportunity in which we can also see and feel the potential that the unorganized to organized play happening. I was personally myself visiting a certain tier 2, 3, 4 cities to just have an exploration of the market. And I could feel that, yes, the unorganized segments there are going through their own set of challenges, and it is only opening up the opportunity for organized players like us to open more stores. So that this is a good sign, and we'll continue to focus on increasing more and more franchisees.
All right. Last question from my end. It's a bookkeeping question. Last year, Q4, our gross margins were very good at 90-odd%, versus full year FY23 level of about 16%. So wanted to check, is Q4 a seasonally strong quarter in terms of gross margin due to higher studded? Is this a normal seasonality?
So, the one thing I did say that the gross margin, Q3 is the best margin. So sometimes the gross margin is also impacted by the price movement. So basically, let us look at a stable gross margin of 14%, right? So what we saw in Q1 and Q2 was a lesser gross margin, and which has been compensated by a full gross margin in the current quarter. So for a whole year, if you look at the EBITDA margin, we have now a blended EBITDA margin of 7% for the whole year. So that is what we are giving the guidance. Primarily, this is due to the stud ratio, higher wedding season sales, and partly movement of the gold price as well.
Got it, Mr. Banka. Thank you for taking my questions, and all the very best to the entire Senco team. Thank you.
Thank you. Next question is from the line of Shirish Pardeshi from Centrum Broking. Please go ahead.
Hi, Shivankar, Mr. Banka. Good afternoon. Thanks for the opportunity and congratulations.
Thank you.
I was more curious. You mentioned that SSG of 17% and South you had a higher SSG. So the background is that when we hear the other competition, they've highlighted the incremental competition which has gone up in Q3, discounting and even the promotions. And in that context, you have got a better SSG. So I just wanted to have a little more color. What is it that you did, or is it primarily led by the store expansion?
No, so the SSG part is where, we've had our stores having more numbers, but the competition is giving the impact in terms of our margins. So if you look at our EBITDA levels, and you will see that it has come down by 30-40 basis points, which is mainly driven by the offers and discounts that not just us, but overall the industry is having to give to continue to attract consumers. And what is happening more is that in the Q3 towards the second half of the quarter, there has been a sudden jump in gold prices, but the wedding season was on. So how do you continue to attract your consumers? Is that you're trying to make the offer more attractive. So till Dhanteras, there was a reason for the consumers to buy because of the auspicious season. And post Dhanteras, there is a need which is marriages, but what is the trigger? And that is where, with an increase in gold price, one has to give attractive offers, and that is the margin impact that you can see for us. So even when and then the SSG part, whether it be South India. Now South India, we have our 4 to 5 stores compared to East India, where the number of stores are that much more higher. But at a lower base, the opportunity, the old gold exchange offers. So, you're giving a 0% deduction on old gold exchange. So that is triggering the consumer to come with their jewelry. So now there is no biasness that you have to go back to your jeweler to get the best value. You can get it from any of the branded jewelers also. So now it's on the play of design, the play of offer, and the play of relationship. So that is, I think, at overall level we are working on.
So if we build on the same store sales growth story, and what we've said is that almost 75 to 80% of our total growth is coming from the existing store, that is a triple SG. Because our average sale per store is still less than 100 crores. So we have certain stores which have reached 100 crores potential. So till the time each and every store reaches the 100 crore potential, that means 155 stores, 100 crores, 15,000 crores. So till the time that sort of base is not achieved, we will continue to have a major growth coming from the existing stores. So that story will remain intact for next 3 to 4 years. That's what we believe.
That's helpful, Mr. Banka. Just one follow-up here. Do you see a starkly different competition angle in the north versus south during this quarter three?
Quarter 3 or quarter 4?
This quarter, you think quarter 4?
No, quarter 3, when I'm saying, do you see a competition is becoming more hyper in the south than north, or it is equal?
Okay. No, so the competition in south has always, it's been a highly competitive market. And as a result, we want to continue to focus on our growth on the eastern and the northern part of the country. And in north, maybe the competition is not as high as south, but the competition surely exists. And we have to all the organized players are endeavoring and striving to take the share of the market from the unorganized. So that's the journey that everyone is doing. And I guess everyone is looking at the coming 10 years, 15 years, rather than just a year or 2 years. So everyone looking long term and wanting to acquire customers.
And moreover, Chris, if we look at our presence in south, we have only 5 stores. I think 3 in Hyderabad and 2 in Bangalore. So our presence and exposure in south is not very high. That is point 1. And south, we know, is a quite competitive market. But since our base is low, we are not at competition to the south players. So we continue to have a different altogether. And we feel that for us, there is ample opportunity to grow. So even in the YTD basis in south, we have grown by 31%. That's against the national growth of 26%. That's how we look our core market now and our core customers even in south.
Okay, that's really helpful. And that's why my second question is that if things are going right, would you track or would you have any number handy that what is the new buyer contribution into the growth, or maybe new buyer contribution if you have a number?
New buyer contribution into the growth. So I'll give you a broad number. The broad number is that suppose X number of transactions we are having for the year, which is around in the range of 5.5 to 6 lakhs. And out of that, around 2 lakhs is the new buyers that are added to the kitty. So that comes to around 35.
These are almost out of almost 45. So what we said earlier, the 45 to 50% are the new buyers. Are the
on 40%.
Yeah.
40% are the new buyers and 60% are your repeat buyers who are already there existing in your system. So this is how we are looking at the overall number. So which is a good sign, because as much as you are worried and concerned, and we are as well in driving that we need to acquire new customers so that the growth continues to happen in the future. So this is how it is.
Okay. Shivankar, that's helpful. My last question. In our core market, during the IPO meet, we had mentioned that we want to increase the ticket size. So when you compare last year quarter 3 versus this year quarter 3 in the West Bengal market, is there any ticket size growth, or the growth actually has come, and what is the number?
The ticket size growth, let's say, I don't have the exact number comparative. So basically, ticket size last time we had shown around 45,000 average pan India and 65,000 ATV. So versus last quarter to this quarter, it has not grown. But what we saw, there was a major shift versus last year to current year. almost from 35 to 45 we have moved, and that we have indicated in our earnings call presentation also, which was indicative of premiumization, but not in the current quarter. So was the last quarter, this quarter, it has not moved, but earlier year to H1, it has moved.
So the ticket size quarter to quarter hasn't moved, but because of the gold price increase that has happened in this particular financial year, so the average ticket size has grown up by 15 to 17%. So from approximately 45,000-50,000 rupees, it has moved up to around 60-odd thousand rupees. So that has been the movement of ticket size growth.
Right. Thank you, and all the best to you, sir.
Thank you. Thank you, sir. So let me again, I would like to share that, because we have our growth analysis in terms of volume as well as in terms of value. So be it in gold or in diamonds. Now, while we can say that, we have grown by 26%, but to what we understand is that the value growth has been around 16-17%, while the volume growth has been around 9 to 10%. And the volume growth for diamond has been 27% and a value growth of 40, and a value growth of gold has been around 9 to 10% and a volume growth of 3 to 4%. So this is where we can see that the overall aspect has worked on.
Thank you.
Kindly allow me to rephrase it. The gold volume growth has been around 9%, 8 to 9%. So out of total 26% growth, we can look at 2-3 angles. How much is SSG and how much is existing? So we say 17% SSG, 8 to 9% new store. That is one angle. Second, we look at gold and diamond. So we say diamond 12%, gold 86%. Third, we look at volume growth and price growth. So versus last year, YOY, when we look at 26%, there has been a 15% price growth. Which means there is 9% volume growth. So in gold, I repeat, out of 26%, 9% volume growth, 26% overall growth, that means 9 plus 17. That is one. And since 26 is a sum total of gold and diamond both, so it is not exactly fully mathematically, but diamond is around 27% volume growth and 41% value growth. So both of these taken together contribute to 26% growth.
Yeah. My mistake, I said 3% volume growth. What Bhaskar is saying is the volume growth in gold is around 9%.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Pallavi Deshpande from Samiksha Capital. Please go ahead.
Yeah. Thank you, sir, for taking my question. Just wanted to understand on the expansion for next year, FY25, how many would be franchisee stores and how many would be the owned stores? And second would be, what would be the sales per store in the south?
Right, ma'am. So, ma'am, in terms of expansion, while we want to open around 18 to 20 stores, our endeavor would be to open 9 to 10 company-owned, company-operated store and 9 to 10 franchisee. So that is what, in all our future growth, we want to open equal number of franchisee and own store, because that will continue to ensure that our return on capital continues to remain robust. However, as we saw in this financial year, when there are these sudden jumps in gold prices, the franchisee partners also takes a little bit of time to get adjusted to the price and then plan for the investment. But that is our plan. And when it comes to the average sales for the southern stores, average store sales.
Average store sale for south is around
27 to 30 crores. These are average sale. And you are aware, ma'am, that in south there are so many retailers and they are doing very close to 100 crores of sales. So the opportunity of growth in the future is very much there, and that is where we see a higher percentage of growth as well happening from Southern India, and that is what our effort will be to striving to grow more and more. However, we continue to be a niche player in South because East and North will be our focus. South will be where we will have stores. We will build up the store. We will try to maximize it. Competition is high in Southern India, but so is the plan around it.
Just to add here, when we are giving the average South store, so out of 5, 3 are old and 2 are new. So for the old stores, they have achieved maturity. They are break even at the OpEx level and also at the inventory level. So every store, it will dilute the average store. So South stores are break even and they are contributing to the bottom line as well. And that's why when we are seeing the maturity of the existing stores, we've opened 2 more stores in South.
Right. And from the inventory part, how do we see it for the March year end? That does it stay? I mean, do we factor in this 400 crore for the year itself increase?
So inventory value, as you said, that inventory, the total inventory as against March 23 has increased, right, by around 300 to 400 kg. So it is gold and diamond both. But what is more important is the inventory turnover. Inventory turnover, which we have earlier indicated. So there is some revision in the representation. So it is below 150 days. So inventory days is below 150 days, and that's why we feel that our inventory turnover is among the best in the industry.
Right, sir. So just lastly, what would be the capex number for next year? We can build in, like you said, only half would be the own store.
You are looking at a capex for the next year, right?
Right.
So basically, when we talk about 15 new stores, as we are now looking at the new store format, that is the modern and the classic format. So let's say 10 to 15 new stores, they will cost, the capex will be at least around 35 to 40 crores. So that is one of the major capex. And since we are focused on IT, as we said that we are a highly tech-driven organization, we have launched beta hours. Our IT systems, our entire systems on IT. So we will continue to invest in IT as well. So then some of the stores we can procure. So we can say around 60 to 70 crore can be the capex plan for the next year. 55 to 65.
55 to 65.
55 to 65, and we have adequate free cash flow for that. So the future growth, as you say, all our future growth requirement for the capex and for the inventory and for the margins for working capital will be funded from the internal accrual and the borrowing. So we have consistently maintained that a sustainable level of the debt equity ratio for the next 3 to 4 years will be 1.2 to 1.25.
Right.
Because our blended borrowing cost is lesser. Since the blended borrowing cost is lesser, so we have to deliver a ROCE of around 15% and return on equity of around 18-19% for the existing stores. At blended level, obviously, when you add a new store, it will optically dilute the overall blended ROCE and ROE. But existing stores will continue to deliver, existing portfolio, I mean, that will continue to deliver at least 19 to 20% ROE and 15 to 16% ROCE.
Right, sir. Thank you so much, sir.
Thank you. Next question is from the line of Vidisha Seth from Ambit Capital. Please go ahead.
Yeah, thanks. So just two more questions from my side. Do you think our current making charges are at par with the industry, or is there more scope to get more competitive in order to gain market share, especially in newer regions like North?
So Vidisha, see, the point is ultimately for the industry, the making charges is where you are earning your margins, and that is where, our gross margins for our company-owned, company-operated stores with a blended way, maybe gold and diamond put together, is in the range of, say, 16, 17, 18%. Now, product to product, because we are focusing more on handcrafted jewelry, that is one. We are confident that, say, we are wanting to develop designs that are selective and something that the consumers can buy. And, the balance between achieving growth and achieving profitability. And also with more and more of our stud ratio going up, we will be able to leverage margins from the studded category and then, pass on that benefit of the profit from studded category by becoming more competitive in the gold category. So the options are there, but at the same time, you can reduce your making charges. But what happens when you want to give offers and discounts, and that is an expectation of the consumer. So you have to be very, sure on what is that optimum price, and when the customer will come and ask for some special offer or offers are across the year, then what discounts you can give. So maybe 1% here and there is an opportunity, and we are keeping a close watch on the market and accordingly optimizing the making charges.
Very clear. And the second was on the lab-grown diamond bit. What makes you confident that value cannibalization of the current natural studded portfolio won't happen? I understand that the customer profile or the occasion could be different, but given that Senco has been able to attract consumers with the proposition of low ticket prices, is there not a scope for these sales getting transferred to the LGD offering? That's where I was coming from. And also, have you worked out on the buyback bit given the moderating prices of lab grown?
Yes. So there is a buyback policy for the lab grown because, in order to make anything a success, and especially the mood and the behavior of the Indian consumer, they would treat jewelry not only as an adornment but also as an investment. So to win the trust and giving them the confidence of the consumer, you need to have a buyback for your product that you sell. So that is very much in place. And when it comes to the opportunity of lab grown, it all depends on the kind of products that you are producing and what you want to sell to the consumer. So at the everyday wear, lightweight jewelry, when there is a lot of fashion and lot of design element associated with it, then your small size diamonds becomes a major factor to create unique designs. But when it comes to lab grown, then what really will add value to the customer is the size of the diamond, where you can see much higher benefit. So there would be certain design differentiation. Ultimately, the ticket size is very critical. And while I wouldn't be able to disclose too much on the strategy, but we will make sure, and what our thought is that through design, we will differentiate between natural diamonds and lab grown.
So just one clarification on the buyback bit. So the buyback would be at existing prices or the prior prices? Because since the prices have been correcting, if we give the buyback at existing prices, won't Senco be incurring losses?
So the buyback will be on the current prices. So it will be 80% value on the. So in the future, if the prices go up, then the customer will benefit out of it. If the prices go down, then it will be a loss to the consumer. So it is not at the price at which you're selling, but at the price at which the customer will be there to exchange or to sell. You get it? So that is how we are making it.
Okay. Thank you.
Thank you. Next question is from the line of Rohit from HRP Capital. Please go ahead.
Yeah, thanks for the opportunity. So what is the revenue mix from Concall franchise store for this quarter versus this?
Your voice is not clear, Rohit. Can you kindly speak query again?
Yeah. So what is the revenue mix for COCO and franchise stores during this quarter? What is this?
65-35. 65-35 the revenue mix for company-owned and franchise stores.
Okay. And sir, were there was any hedging gain included at the gross margin or EBITDA level?
So what we are saying is that, no, we don't want to answer this question very specifically. We are following the Ind AS accounting, right? In the Ind AS accounting, which is derivative of the IFRS, the hedging gains and losses are adjusted to the inventory. And since they are adjusted to the inventory, they will be impacting the gross margin. So if there is a price rise, there will be hedging loss and vice versa, which will be impacted in the gross margin. So net, the impact of Ind AS is to nullify the impact of gain and loss. We are fully hedged, which we have maintained regularly, and we are more than 90% hedged for the last quarter. So technically, from a business perspective, we are not a hedge fund. We don't make money from keeping the exposure open. So to that extent, from corporate governance perspective, we are almost hedged when we say 90% hedged. But yes, Ind AS accounting is a regulatory framework which we have to follow.
Okay, so what 90% inventory is hedged?
Yes, 90% of the inventory is hedged. That we confirm once again.
Okay, sir. On store addition, during last quarter call, you mentioned that for the remaining financial year, you will have 8 to 10 stores on the base of 153 stores. But in the recent management interview, it was 3 to 4 stores will be added in Q4 on the base of 154 stores. So, is there reason for reduction in store addition guidance?
So the store addition is a factor of company-owned store and franchisee. So because we have only added 4 franchisee store, and we could add the rest as a company-owned, company-operated store, and certain franchisees opening got postponed to the next financial year or the next quarter. So we are reducing the guidance on the store opening.
Okay, thank you, sir. That's all from my side.
Thank you. Next question is from the line of Vinod, an individual investor. Please go ahead.
Hi, sir. I have 2-3 questions on the growth. First, you have about 90 stores in West Bengal alone. Any sense how many more you can open in the next, say, 3 years?
Yes, we've done our analysis, and we believe that we can minimum open 10 to 12 more stores, if not more, because it is not only the stores that you open in the bigger cities, it is also the stores that you open in the tier 2, 3, 4 markets. And, because of our franchisee model, even in the smaller towns, there have been small markets and there have been unorganized small, size players. Now with government making hallmarking more mandatory, the supply chain, the sourcing for those jewelers are getting a little more difficult. So everyone is looking for an opportunity. Maybe the existing, any kind of businessman in that particular town. So we can minimum add 10 to 12, if not more.
This is 10 to 12 per annum or cumulative over 3 years?
No, 10. I would say over 2 years, 10 to 12. Maybe over 3 years, it could go up to 15 plus also. But let's keep it at 10 to 12, and per annum it could be 5, 6 minimum.
Sure. And now looking at the broader East, what would be your market share in the East overall jewelry market today, and what was it 3 years back?
So see, market share is something that, the numbers are not really, out in the open. It is all based on estimation. So number of stores are something that is, the numbers are very much clear and evident. The rest is that where I guess all of us have to understand that what the other players are selling. If the total market is 7 lakh crore industry, 15% of that, which is 1 lakh crore, is your East industry size. and out of that, assuming that 40 to 50% is your organized segment, that is around 40 to 50,000 crore. And then you need to analyze that how much is the share of our other jewelers where the data is out in the public or from East, and then our business from the East is around 70 to 80% of our overall turnover. So then I guess you will get some idea that we maybe hold around 3% or 5, maybe 10% of the organized segment and 3 to 4% of the overall market. This is our estimate, but the numbers again is all one has to do much more analysis to come to the correct figure.
Understand. And with the limitations on data that we have, and I believe you are best placed compared to us, you said 3 to 4% of the overall East market. Any sense, based upon estimates as handicapped as they are, what was that number like, say, 3 years or 5 years back against this 4% now?
So one thing you must keep in mind is that the industry hasn't grown much over the last 4-5 years, right? In terms of value, it has grown, but in terms of volume, the imports into the country has been in the range of 600 to 700 tons on an average, right? So, and there is a steady shift that is happening from the unorganized to organized in a pretty big way. Again, these are all estimates. So if today we are at 3 to 4% of the market, I would say that maybe we've been growing 20% minimum year on year over the last 4-5 years, right? So that means that we've almost doubled. And so you could say it was 2.5% maybe 4-5 years back. So these are again, I'm just giving an answer based on the estimates.
Right. But I'm just circling back to the older question on the stores you could open in Bengal. You said 5 to 6 per annum. Fair to presume that you have already sort of earmarked the places that you want to open the stores, not necessarily zero on the location, but the cities or the micro market you want to be in, and therefore you have greater visibility on the locations?
Yes, so we won't be able to share the details of the location, but we are more or less studying the market deeply. And it is not just Bengal. We are doing it for the markets in eastern part of the country because strategically we want to focus on East, that is where our core competence is, and North as the future market potential. So we have got a whole list of locations lined up, and based on the opportunities, we will always try to grow there accordingly.
So, I asked this question just to play a devil's advocate here that, you have a strong presence in East. One could always question that what after East? If Bengal is, which is where you have...
So Bengal is only one state. Then you have 4-5 more states in East. So your 1-2 year journey, say 2 years journey in a particular state, and then you become the market leader and you capture more from the unorganized. Just as a flow, then you are focusing on the 5-6 other states of Eastern India. Parallelly, you are putting your base. So we believe in the hub and spoke model. So we've been there in North. We will then start penetrating into the various states. We have already penetrated with more than 20 stores in North India. So then the brand gets stronger and stronger, and we will penetrate in the North India. And then, maybe that itself is a 3-4 year journey. Then is your journey into Central and West, and then last will be, in the South, because South is a highly competitive market. So this is the journey that we see over the next 5 to 10 years.
So, sir, if I can build on that. So when we talk about East, out of all the stores, we talk about Bengal, or stores in Bengal are 90, right? And East is 27, that is 117. So when we talk about East, we have got Bihar, Jharkhand, Odisha, Assam, Tripura, right? So we have store in Tripura also. Chhattisgarh, today, Chhattisgarh we are taking MPCG. So there is huge scope in these stores, and so that you have to understand a difference. Our competition is not to the players with whom you are thinking. we will be a major player in the movement from unorganized to organized. That is Tier 3 and Tier 4. So when we go to Bhagalpur, when we go to Ara, when we go to Jaleshwar, when we go to Dumka, so this is in our target list. There are a huge list of such cities and towns where there is a potential, and we will look for these locations in future also.
Right. I stressed on this question because if you look at last 3-year data for which you have from F21, you have a total of 43 stores open, out of which 21 alone were in Bengal. So one worries if Bengal is going to slow down a little bit in terms of new store opening because you are saturating that. Could it therefore impact the overall growth in the company at the level of profits that you'd like to grow?
So this might be addressed earlier. See, one is the store presence, and second is the ASP, ATV, and average sale per stores, right? So with what we've said, there are many stores which have achieved the 100 crore top line level, right? And our average overall blended national average is 37 crore. West Bengal is maybe mid-level. So there is a scope to improve the ASP, ATV, and average sale per store before Bengal opportunity is out. So we don't see that Bengal opportunity will be out before next 10, 15 years. And then there are still many cities in Bengal where we still have to reach. So the constraint is only imagination. That's how we can say. That is only a constraint. The market is unlimited. We are talking about a 40% only organized market. 60% market is huge opportunity. And we don't see that anyone is at competition. We all will be catering to our respective customer segment, and there will be ample and huge opportunity for everyone to grow and serve the customer in Tier 3 and Tier 4.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question of the day. I now hand the conference over to management for closing comments.
So thank you very much. It is truly a great experience, I would say, and a pleasure on behalf of Senco Gold and Diamonds to, come across, interact with all of you, update with all the numbers. And once again, we are very happy and excited that we've had a wonderful Q3, and we look forward to a robust Q4, I might say. At the same time, we all are we need to be conscious that how the coming year will be, the coming calendar year, the coming financial year. We've had Valentine's Day offer. The wedding season is around in Q4, and that is what the drivers are towards the sales and the numbers that we are doing for Q4. Then comes the Q1 of the next financial year, which is again we look forward to in terms of Akshay Tritiya and the New Year that happens in various states. But at the same time, we need to be conscious on the consumer behavior and how the footfalls at the retail will be. There are elections coming up in the country, so that has its own impacts. Maybe the demand might get crossed over from Q1 to Q2. We are aware that the wedding season for the upcoming financial year, there are fewer weddings in the first half of the year, and the weddings will be only in the month of November, December onwards. So the management of Senco is accordingly planning to ensure that the multiple locations that is there in the first half of the year, we continue to come up with our new offers, schemes, new products, new collections, new designs to ensure that the customers continue to stay excited and buy from the jewelry industry and for our company as well. And look forward to interacting with all of you after the end of Q4 as well. And have a great day and happy Valentine's Day and a happy Saraswati Puja once again. Thank you.
Thank you. On behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.